History, as the saying goes, often rhymes. By examining the anatomy and consequences of past stock market crashes, we can gain valuable insights into the patterns and potential pitfalls of the financial system. In Part 1, we explored the underlying mechanisms and common precursors of these dramatic events. Now in Part 2, we'll turn our attention to specific case studies, some of the most significant market meltdowns in history, to understand their unique triggers, the immediate chaos they unleashed, and the lasting impact they had on the global economy. The crash of 1929 and the Great Depression, the mother of all crashes. Perhaps the most infamous of all stock market crashes, the Wall Street crash of 1929, marked the beginning of the Great Depression, a decade of unprecedented economic hardship. Fueled by rampant speculation, easy credit, and a belief in perpetually rising stock prices, the market reached unsustainable heights. Black Tuesday, October 29, 1929, saw a catastrophic sell-off, triggering a chain reaction that led to bank failures, business closures, and mass unemployment. The lessons of 1929, the dangers of unchecked speculation, and the interconnectedness of the financial system continue to resonate today. Black Monday, 1987, a flash of panic in a globalized world. Nearly 6 decades later, the world witnessed another dramatic market meltdown. Black Monday, October 19, 1987. Unlike 1929, there wasn't a clear, singular economic trigger. Instead, factors like program trading, portfolio insurance strategies, and global interconnectedness amplified a wave of panic selling. Markets around the world experienced unprecedented single-day declines. While the crash was severe and swift, the economic fallout was less prolonged than in 1929, partly due to swift intervention by central banks. Black Monday highlighted the increasing complexity and interconnectedness of global financial markets. The dot-com bubble burst, 2000 to 2002. Irrational exuberance meets reality. The late 1990s saw the rise of the internet and a wave of enthusiasm for new technology companies. Stock prices of dot-com companies soared to dizzying heights, often with little or no underlying profitability. This period of irrational exuberance eventually gave way to reality. As investors began to question the unsustainable valuations, the bubble burst, leading to a significant market downturn that lasted for several years. The dot-com crash served as a stark reminder of the dangers of investing in hype without fundamental analysis. The global financial crisis of 2008 to 2009, the perils of interconnected debt. The global financial crisis of 2008 to 2009 was arguably the most significant financial shock since the Great Depression. It originated in the U.S. housing market, where a boom fueled by subprime mortgages created a complex web of interconnected debt. When the housing bubble burst, it triggered a cascading effect throughout the financial system, leading to the collapse of major institutions and a severe global recession. The 2008 crisis underscored the systemic risks inherent in complex financial instruments and the devastating consequences of unchecked leverage. The 2015 to 2016 Chinese stock market crash and global jitters. In the mid-2010s, another significant stock market event unfolded in China, sending ripples across global markets. Between 2014 and mid-2015, the Shanghai Composite Index experienced a dramatic surge, fueled by speculative trading and easy credit. However, this rapid ascent proved unsustainable. In the summer of 2015, the bubble burst, leading to a sharp and swift decline in Chinese equities. This crash was exacerbated by factors like margin calls and government interventions that initially failed to stem the selling pressure. The turmoil in the Chinese market had a contagion effect, triggering volatility in other global markets. Furthermore, events like the devaluation of the Chinese yuan and the Brexit referendum in 2016 added to the global economic uncertainty and contributed to periods of market instability. This episode highlighted the increasing interconnectedness of global financial markets and how events in one major economy can quickly impact others. The COVID-19 pandemic crash of 2020, a black swan event. The onset of the COVID-19 pandemic in early 2020 triggered a unique and dramatic stock market crash. As the virus spread globally, leading to widespread lockdowns and economic uncertainty, investors panicked. Markets experienced some of the fastest and steepest declines in history, with multiple trading halts triggered by the speed of the sell-off. However, this crash was followed by an equally swift and remarkable recovery, fueled by unprecedented levels of government and central bank intervention, as well as the rapid development and rollout of vaccines. The COVID-19 crash demonstrated the market's sensitivity to unforeseen black swan events and the powerful impact of coordinated global policy responses. It also highlighted the resilience of certain sectors, particularly technology, in the face of economic disruption. From the bursting of the dot-com bubble to the unprecedented events of the COVID-19 pandemic, history is replete with examples of stock market and asset bubble crashes. Each event carries its own unique characteristics and lessons, reminding us of the cyclical nature of markets and the importance of understanding the underlying risks. In Part 3, we will explore how to navigate the aftermath of these turbulent times and prepare for the inevitable uncertainties of the future.